Let us now summarize all the accounting concepts quickly. Entity concept meant that the owner and the business are separate entities. The business records any transaction with the owner separately. If the owner brings in money, the business records it as a capital, as a liability to the owner. If the owner withdraws money, the business records it as a drawings, meaning that the owner now owes money to the business. So entity concept. There is a separate entity. Owner is separate from the business as far as accounting is concerned. Money measurement concept. Only transactions which can be measured in terms of money would be considered. And the unit of measurement is the currency of the country in which the accounts are kept. Any other transaction, however important, however crucial to the survival of the organization, may not find place in the accounting records if it cannot be measured in terms of money. Next, we did going concern concept. This was a fundamental accounting assumption. Going concern concept, which meant that the business would go on for a long period of time. That is always a basic assumption. If that is not there, if that is not true, and the business is going to be wound up within a month or two, within a short period of time, then accounts are also prepared on a realization basis, on a slightly different basis. Periodicity concept, it follows from the going concern concept. Since the business has a long life, we need to break it up into certain periods in order to assess the performance of the business. So, books of accounts are closed every year to assess the performance of the business. That is periodicity concept. What is an accrual concept? Accrual concept says that all expenses must be recognized as expense whether they have actually been paid or not. Similarly, all incomes, if earned, must be recognized irrespective of whether they have actually been received or not. Similarly, if any expense for the next period is paid today, it is not recognized as expense for the current period. It must be recognized as expense only in the next period. Accrual concept also is a fundamental accounting assumption. Matching concept. Matching concept largely says, how do you decide what costs to be recognized? Costs which have been incurred to earn the revenues for the current period are to be matched. Those costs which are incurred to earn the revenues for the period must be recognized as expense. Similarly, expense for a particular period are also considered as expense, like rent, telephone charges, etc. It may not be easy to relate these expenses directly to the incomes which are earned. Cost concept. Cost concept states that when we record any purchase of assets, etc., it is recorded at the price at the price that we pay for the same. Recorded at cost, not at the actual value, not at the value, not at any different value that it may supposedly have. Having said that, today we have a lot of revaluation. We have something called fair value valuations, etc. But traditionally, we record all transactions at the cost, at the actual cost, so that there is no element of subjectivity. Realization concept states that revenues are recognized only when actually realized. Only when actually realized. What is realization? Not necessarily that cash is received, but when the transaction is effected. Dual aspect. Every transaction has has two sides of the transaction. A basic accounting equation in this case was assets minus liabilities is equal to equity, or asset equal to liabilities plus equity. Any transaction follows this fundamental accounting equation. Conservatism. As per the law of conservatism, we provide for any anticipated losses. So if we expect a loss in future, it is provided for. If we expect a profit in future, that is not recognized. Profits would be recognized only when they actually occur, only when they are actually realized. However, if we anticipate losses, then we should make a provision for the same. What is consistency? Consistency is when we adopt certain accounting policies that should be consistently followed year after year. Can we never make changes? No, we can make changes when it is required by law, when it is required by an accounting standard, or when we feel that the change in the accounting policy will result in a better disclosure of the presentation of the financial statements. In that case, the fact of the change should be disclosed. We must disclose in our financial statements the fact that we have changed an accounting policy and what is the effect on the profit due to this change in policy. What is materiality? Materiality, mind you, is may be different, may vary from organization to organization or from situation to situation. What is material for one business may not be material for the other. What is materiality? Materiality would be that fact which the omission of which might change the decision of the user of the financial statement. If we make a misstatement or do not give some information, but had we given that information or that misstatement would result in a change in the user's decision, that is considered as material. Here, consistency is also a fundamental accounting concept. Yeah, fundamental accounting concepts are going concern, consistency, and accrual.